already felt the economy was doing just fine. And you've heard me say many times, America needs workers, not jobs. And this is a good report of that. But I really appreciate, Tom, how you frame this. You say it's not about this one report. Exactly. It's about what this report and the labor market is telling us about the broad economy. And there's so many interesting stories within this May job report that are really synonymous with other trends that we're seeing. So, for example, there's some cyclical momentum forming underneath. The gains that we saw today were pretty broad across all the sectors, not just about healthcare. There's signs the consumer is okay. So, leisure and hospitality having a big number. We watch that not because we're trying to forecast the next leisure and hospitality number, but because we want to know what the consumer's doing. We're looking for evidence of tariffs impacting the job market, and so far that seems okay as well. It looks like businesses are passing on those price pressures through the inflation channel, not through the jobs channel. And we still got a hearty support from those healthcare added jobs. So when I put that story together, for a long time, the goal of The Economist was to get that non-farm payroll number right. You were sort of measured by how well you could forecast that. I don't know if it's just because I'm getting older, but now I use the NFP number to help me forecast where the economy is going to be in 6 to 12 months. And when I do that, it tells me that our view that we're going to come in around 2% growth this year is right on track.
Hey, Francis, the marketplace here, and I look at the work function, and Bloomberg had this red headline, pricing in a 25% hike in rates by the end of this year. How does that jive with you?
Well, I can't help but think about all those dissenters at the last Fed meeting who said, hey, we should not have an easing bias in this statement. I have to believe that they are smiling this morning that they were indeed right. Let's start by removing the easing bias, which when you're looking at, stable employment, an unemployment rate of 4.3%, and if you go out the double or triple decimal, improving on that front, and inflation that's probably on headline basis going to come in about 4% this month. There's no reason for an easing bias. The data is simply not providing that. However, a hiking bias, I'm just not there yet. There's no wage spiral evidence in the data. And core inflation is still okay. So that gives them some time to wait out another few reports. But if you're asking me where our bias is, it's absolutely a hold or hike conversation as we think through what the next move from the Fed will be over the next 6 to 12 months. But the dissenters got it right, is the headline to me this morning.
Francis Donald with us with RBC Capital Markets off this big jobs report, and of course, right into next week. So if I got 2% real GDP, okay, let's say you're wrong, 2.2%, whatever the number. I add on an inflation. Do I have a banana republic nominal of 5 or dare I say 6% nominal GDP?
Well, that's the math of it. This is an economy that's really hard to bet against. Now, up until now, it's been hard to bet against it because of structural factors. And there's been these 3 heavy pillars: AI, government, and then sort of that healthcare sector that's providing support underneath the US economy. And it was really hard to see those shaking. What's moving now in the last 2 to 3 weeks is that structural support overlaid with some cyclical momentum. Now, Tom, it's still early. I'm not going to make a big, bold call here, but when you layer in structural guardrails with some cyclical support coming from slightly better consumer than maybe we were expecting, some relief on tariffs, then you start to get towards a different sort of paradigm. And yet, I say it's early because there's still some things we need to be watching. We need to see how much inflation producers can pass on to consumers. Real wages are going negative for the second month in a row. Looks pretty clear from today's average hourly ratings. So there's going to be a limit to that. And we are in temporary relief with tariffs. I know we don't talk about tariffs anymore, but it's very clear to us that this is producing pressure on businesses in America. We got that IEEPA hold. Now, just this week, you've seen Section 301 tariffs coming through. So we got to be a little bit cautious here. I, of course, have been optimistic, as I say, really hard to bet against the U.S. economy, but we also have to manage the risks. And there are risks on both sides right now. It's just that we spent so long talking about the downside risks, we've avoided talking about the upside risks. And clearly, there are some of those as well.
I'm glad you called out the wages here, Francis, because we did have average hourly earnings rise 3.4%. That was lower than last period. But I look ahead to next week in CPI, and the core year-over-year is 4.2%. So it looks like the consumer, vis-a-vis inflation, struggling. How do you think about the consumer these days?
Yeah, it's such a great point. For years, when you were taught as an economist to look at the US economy, you were told the US economy is the US consumer. And the US consumer is, do they have jobs or not? And as long as the job market was doing well, then the US consumer was doing well and the US economy was doing well. And that's why I said earlier, the whole goal of the Economist was to predict the non-farm payrolls number. The challenge now is that if you're an American and you want a job, you probably have one, especially if you're over the age of 25. It's not if you have a job in America that matters anymore. It's whether it pays you enough to afford the cost of living. And that's not just a wages story, Paul. It's also an hours worked number. Okay. So today, what I was looking at most closely wasn't just the average hourly earnings, which is decelerating. It's did we see any decline in the amount of hours of employment worked? And no, we didn't see that. We actually saw a nice stable element of that. So for me, we really have to shift our perception away from what's the unemployment rate that's going to stay low to is it providing enough? And we know from the numbers it's not. And there'll be a limit to how long the consumer can hold on.
A gift to you across the nation. Francis Donald with us. We continue with Francis Donald of RBC here. Off the jobs report, all you need to know is a massive shift in the Sweeney yield. The 2-year was up 10 basis points. It is up now an explosive 13 basis points, 9 basis points, 4.13% on the 2-year yield, 30-year bond, 5.01%. Francis, I think the cacophony of news, and of course the war and all that, we're looking at the algebraic function, and there's a lot of stuff we're not talking about. Like, we're not talking about the massive changes in immigration. We're not talking about this massive delta of declining government employment as well. Do you have clarity out into 2027?
Oh, we never know what policies will be around things like immigration or even what government employment will look like. But we do spend an enormous amount of time, Tom, talking about retirements. You've heard me talk about this before and how critical they've been to the decline in labor force participation rates, which has sharply declined through 2026, and just what this means for the general state of the U.S. economy. So our estimate of break-even employment in the U.S. is 20,000. The U.S. only needs to add 20,000 jobs per month now to keep the unemployment rate stable. And that is largely driven by retirements more than changes in immigration policy. But it so clearly contributes to our view that, again, America needs workers, not jobs. But Tom, it also impacts income. 20% of income in the United States right now is government transfers, money from Washington into households across the country. And the larger that becomes, the less cyclical the U.S. economy will be. Because if you're getting a paycheck every month that's inflation adjusted and doesn't matter if there's a recession in play, the economy operates differently.
See, like if the Canadians had gone to the finals, Francis would be on her way to Las Vegas.
Yes, she would.
Neil Dutta is living large.
Yep.
He's down in Spurs country seeing back-to-back Knicks games. His screen, his Bloomberg terminal tells me he's working.
I know, I'm
with
not
Jeff
buying it.
DeGraff this morning. I'm not buying it. I think it's massive work from San Antonio. Francis, I love this single sentence from Neil Dutta of Renmac. I want you to comment on this. Stagflation is bad for stocks. An inflationary boom is not. So the ambiguity here is there can be a good side, stocks up, to a quality boom economy, right?
So the way that we think about that is that think about growth and inflation like a 2x2 matrix. You've got growth up or down, inflation up or down. Now, when you have growth down and inflation up, that's one quadrant. We call that stagflation. But when you have growth higher and inflation higher, that's a heating up economy that we typically call reflation. There's an enormous amount of work coming from the sell side on where we are in those four quadrants and just how different an environment they are. Yeah. But one of the big challenges is reflation, very clear Fed response. They know what to do in that type of environment. Usually your labor market's getting real tight and inflation is high. You can hike rates, which is why you get different market responses to early rate hikes. But when you have a stagflation environment, that's the Fed's dual mandate pulling in opposite directions. Not only does that create a bad environment for businesses, just everyday folks operating on the ground trying to run their companies, it's also enormously challenging for central banks. So even though right now probably, new Fed Chair Warsh is sitting there saying, oh my goodness, I probably can't cut, at least he doesn't have the mandate pulling in opposite directions. That would be a much harder first meeting. This one, at least from a traditional lens, excluding the politics of it, is fairly straightforward.
Really well said versus New Zealand and a few other choice geographies.